Welcome to Learn Through Books. In our first playlist, we will look at personal investment, wealth, and finance. If you like what you hear, then please like and subscribe to the channel. In addition, be sure to take our poll to let us know which books you'd like to listen to next, as well as how long you'd like the videos to be in the future. Thank you for tuning in, and we look forward to having you at the next video. In our first ever video, we will be presenting Invested: How I Learned to Master My Mind, My Fears, and My Money to Achieve Financial Freedom and Live a More Authentic Life, by Danielle Town and Phil Town. Now on with the book. In this introduction, we explore the chapter titled, How to Use This Book. The author begins by acknowledging the common feelings of confusion and fear that many people experience when it comes to personal finance and investing. This sentiment resonates with many readers who may feel lost in a sea of numbers and financial jargon. The author shares their own journey, highlighting that they were once financially illiterate, but have since transformed into an educated investor. This transformation serves as a beacon of hope for readers, suggesting that if the author can do it, so can they. A significant theme in this chapter is the importance of aligning investments with personal values. The author emphasizes that investing is not just about making money. It's also about supporting causes and companies that resonate with one's beliefs. This perspective can make investing feel more purposeful and fulfilling. Fear is another critical aspect discussed in this chapter. The author reflects on how fear can paralyze investors, but also serve as a powerful motivator. By learning to harness fear, investors can identify opportunities in the market, especially during downturns. The author's investing practice is introduced as a structured approach that anyone can adopt, regardless of their financial background or math skills. This practice aims to make investing accessible and integrated into everyday life, allowing individuals to take control of their financial futures. In this section, we delve deeper into the author's journey as a reluctant investor. Initially, the author expresses a strong aversion to numbers and the complexities of investing. This reluctance is common among many individuals who feel intimidated by the financial world. However, the author found inspiration in the teachings of renowned investors like Charlie Munger and Warren Buffett, who have shaped their understanding of investing. The concept of Rule Number 1 investing is introduced as a foundational principle that guides the author's investment decisions. This rule emphasizes the importance of investing in what you understand and believe in, which aligns with the author's values. As the author navigates their journey, they confront their fears head-on. They acknowledge that fear is a natural part of investing, especially during turbulent market conditions. By learning to understand market cycles, including inevitable crashes, the author transforms their fear into a strategic advantage. This shift in mindset empowers them to seize opportunities during downturns, viewing market crashes as chances to invest in quality companies at discounted prices. This perspective not only alleviates fear, but also fosters a sense of control and confidence in their investment decisions. This section focuses on the idea of investing with purpose. The author emphasizes the significance of aligning investments with personal values and missions. This alignment transforms investing from a mere financial activity into a meaningful endeavor that reflects one's beliefs and aspirations. The phrase "voting with your money" encapsulates this idea, suggesting that every investment decision is a statement about what you support and believe in. The emotional connection to investing is highlighted as a crucial factor in maintaining discipline and commitment. When investors are passionate about their investments, they are more likely to stay engaged and informed. This passion can serve as a powerful motivator, especially during challenging times when fear may threaten to derail their investment strategies. The author also addresses the common struggle of inertia and fear that many face when considering investments. By providing strategies to overcome these barriers, the author encourages readers to take proactive steps toward their financial goals. Continuous learning is emphasized as a vital component of successful investing. The more knowledge investors acquire, the more confident they become in their decisions, allowing them to navigate the complexities of the financial world with greater ease. In this part of the chapter, the author introduces their monthly investing practice framework, designed to guide readers through the investment process in a structured yet flexible manner. Each month is dedicated to specific actions and exercises that help build a solid foundation for investing. This approach allows individuals to focus on one aspect of investing at a time, making the process less overwhelming. Flexibility is a key theme in this framework. The author encourages readers to adapt the practice to their unique circumstances, recognizing that everyone's financial situation and goals are different. This personalization is crucial for fostering a sense of ownership and commitment to the investing journey. Time management is also emphasized, as the author acknowledges that many readers lead busy lives. The investing practice is designed to fit into the lives of full-time workers, ensuring that investing does not become an additional burden. To support readers further, the author provides valuable resources, including calculations, checklists, and worksheets, which can streamline the investing process. Ultimately, the author encourages readers to make their investing journey their own. By personalizing their approach and integrating it into their daily lives, individuals can cultivate a powerful skill that will serve them well throughout their lives. This empowerment is a central theme, as the author hopes to inspire readers to view investing not just as a means to an end, but as a source of happiness and freedom. In the final section of the chapter, the author reflects on the joy of investing and its potential to bring happiness and freedom into one's life. This perspective shifts the narrative around investing from one of fear and anxiety to one of empowerment and fulfillment. The author emphasizes that financial freedom is not just about accumulating wealth. It is also about achieving personal fulfillment and living a life aligned with one's values. The author shares their own experience of finding deep happiness through investing, highlighting that this joy comes from actively participating in the creation of the life they desire. This sense of agency is a powerful motivator for readers, encouraging them to set their own personal investment goals and pursue them with passion. The transformative power of financial literacy is underscored, as the author believes that understanding investing can lead to profound changes in one's life. By becoming financially literate, individuals can break free from the constraints of fear and uncertainty, allowing them to embrace the opportunities that investing presents. Finally, the author issues a call to action for readers to embark on their investing journey. This invitation is framed as an opportunity for growth, learning, and ultimately happiness. The chapter concludes with an optimistic outlook, encouraging readers to take the first steps toward financial empowerment and to embrace the joy that investing can bring. In this chapter, the author shares her personal journey as a low-level lawyer in Boulder, Colorado, and the challenges she faced in balancing her demanding career with her desire for a fulfilling life. She reflects on the long hours and stress that come with working at a prestigious law firm, realizing that despite her hard work, she was merely on a treadmill with no end in sight. The author emphasizes the importance of financial freedom, recognizing that while money cannot buy happiness, it can provide the means to live a life of choice and joy. The chapter also highlights the toll that stress took on her health, leading to various physical ailments, and her growing desire to break free from the constraints of her job to pursue a more meaningful existence. This sets the stage for her exploration of investing and financial independence. The author delves deeper into the concept of the treadmill effect, where despite her initial excitement about her legal career, she finds herself trapped in a cycle of overwork and stress. She observes that many of her colleagues, despite their success, are also struggling with the same issues, leading to a collective sense of burnout. This realization prompts her to question the traditional path of success and the sacrifices made in pursuit of it. The author reflects on the importance of finding a balance between work and personal life, recognizing that financial security is essential for achieving true happiness. This section emphasizes the need to break free from societal expectations and redefine what success means on a personal level. In this part of the chapter, the author explores the complex relationship between money and happiness. She acknowledges that while money cannot buy happiness directly, it can provide the freedom to make choices that lead to a more fulfilling life. The author reflects on her desire for financial independence, recognizing that it would allow her to pursue her passions and create meaningful experiences. She also discusses the impact of financial stress on her relationships, highlighting the importance of financial security in maintaining personal connections. This section serves as a pivotal moment in the author's journey, as she begins to understand the role that money plays in achieving a balanced and joyful life. The author recounts a pivotal conversation with her father, who emphasizes the importance of investing as a means to achieve financial freedom. He introduces her to the principles of value investing, which focus on buying stocks based on their intrinsic value rather than market trends. Despite her initial resistance and fear of the complexities of investing, the author begins to see the potential for investing to provide the financial security she craves. This section highlights the significance of financial literacy and the need to develop a strategy for managing money effectively. The author's journey toward understanding investing marks a turning point in her quest for a more balanced and fulfilling life. In the final section of the chapter, the author makes a commitment to take action towards achieving financial freedom by learning about investing. She conceptualizes her approach as an investing practice, similar to her legal practice, emphasizing the importance of continuous learning and growth. The author recognizes the need to set clear financial goals and the role of mentorship in her journey, particularly the guidance from her father. This decision to actively pursue financial education marks a significant shift in her mindset, as she embraces the idea that she can take control of her financial future. The chapter concludes with a sense of hope and determination, as the author embarks on her journey towards financial independence and a more fulfilling life. In this chapter, the author reflects on the journey of understanding personal finance and investing. The chapter begins with the author's apprehension about investing and the need for a structured approach to stay accountable. The author discusses the stock market, explaining its significance and how it operates, including the historical context of stock trading. The chapter emphasizes the importance of understanding the market before diving into investments. The author also highlights the role of financial advisors and money managers, expressing a desire to abdicate responsibility for investment decisions. This sets the stage for exploring various investment options available to individuals. The author delves deeper into the concept of the stock market, defining it as a marketplace where stocks are bought and sold. The major exchanges such as the New York Stock Exchange and NASDAQ are introduced, along with their significance in the global economy. The chapter provides a historical perspective, tracing the origins of stock trading back to the 1600s in the Netherlands, where shares of companies were first sold to the public. The author describes the trading process, emphasizing the dynamic nature of price negotiations between buyers and sellers. Additionally, the evolution of technology in trading is discussed, highlighting how electronic trading has transformed the market. This understanding is crucial for anyone looking to invest. In this section, the author explores the various options available for investing, particularly focusing on the appeal of abdication, handing over investment decisions to professionals. The chapter outlines different investment vehicles, including mutual funds, exchange-traded funds, ETFs, and robo-advisors, explaining how each works and the associated costs. The author emphasizes the importance of being aware of fees, which can significantly impact returns over time. The challenge of finding a competent money manager is also discussed, highlighting the need for investors to be informed and proactive in their investment choices. This section serves as a critical reminder that while abdication may seem appealing, it often comes with hidden costs and risks. The author introduces the concept of my number, which represents the amount of money needed to achieve financial independence. This section discusses the various factors that influence how much one needs to save and invest to reach this goal. A significant focus is placed on the power of compounding returns, illustrating how reinvesting earnings can lead to substantial growth over time. The author also addresses the impact of inflation on savings, emphasizing the importance of considering inflation when planning for the future. Strategies for achieving financial goals are discussed, encouraging readers to take proactive steps toward understanding their financial needs and making informed investment decisions. In the final section of the chapter, the author emphasizes the importance of thankfulness in the context of investing. Drawing inspiration from successful investors, the author highlights how gratitude can positively influence decision-making and overall mindset. The psychological benefits of practicing thankfulness are discussed, suggesting that a positive outlook can lead to better financial outcomes. The chapter encourages readers to incorporate thankfulness into their daily lives, fostering a mindset that is conducive to success. This connection between mindset and financial success serves as a powerful reminder that investing is not just about numbers, but also about the attitudes and beliefs that drive our decisions. In this chapter, the author reflects on the journey of learning to invest, emphasizing the importance of creating a conducive environment for this practice. The chapter begins with the author's commitment to investing alongside their father, despite feeling overwhelmed by the complexities of the financial world. The author shares personal anecdotes about how organizing their physical space can lead to a clearer mindset, which is crucial when tackling the intricacies of investing. The author draws parallels between their yoga practice and investing, highlighting the need for a grounding space that encourages consistent practice. This leads to the realization that without a dedicated investing environment, the motivation to engage in this practice may dwindle. The chapter sets the stage for understanding how a well-organized and inviting space can foster a more productive investing experience, ultimately making the process feel less daunting and more manageable. In this section, the author delves into the practical steps taken to create an investing office within the constraints of a small apartment. Drawing inspiration from renowned investors like Guy Spire, the author emphasizes the significance of personalizing the investing space to reflect one's values and motivations. The chapter discusses the use of talismans and reminders that serve as motivational tools, such as a heart-shaped stone symbolizing gratitude for overcoming past challenges. The author also highlights the importance of organization, noting that a clutter-free environment can lead to a more focused and productive investing practice. By creating a space that resonates with personal values and aspirations, the author aims to cultivate a sense of commitment and enthusiasm for investing, transforming it from a chore into a fulfilling practice. This part of the chapter explores the historical evolution of corporations and the concept of limited liability, which has significantly shaped the landscape of investing. The author explains how limited liability encourages entrepreneurship by protecting personal assets, but also introduces ethical dilemmas regarding corporate behavior. The dual nature of corporations is highlighted, where some companies act as positive forces in society, while others may engage in unethical practices. This realization prompts the author to seek out values-driven investments, focusing on companies that align with personal ethics and contribute positively to society. Additionally, the author addresses the inherent information asymmetry between shareholders and corporate management, emphasizing the need for investors to be vigilant and informed. This section underscores the importance of understanding the corporate structure and the ethical implications of investing in various companies, setting the stage for a more conscious approach to investment decisions. In this segment, the author introduces the powerful idea of voting with my money, which emphasizes the impact of consumer choices on corporate behavior. By choosing to invest in companies that align with personal values, the author believes that investors can influence the market and promote ethical practices. The chapter discusses how everyday purchasing decisions reflect individual morals and how this can be extended to the stock market. The author highlights the potential for collective action among small investors to drive significant change, suggesting that when individuals invest in companies with strong missions, they can help create a more ethical corporate landscape. This section serves as a call to action for investors to be mindful of their choices, reinforcing the idea that every investment is a vote for the kind of world they want to see. The author expresses excitement about the possibility of supporting companies that prioritize ethical practices and contribute positively to society, framing investing as a meaningful and impactful endeavor. The final section of the chapter focuses on the concept of the story of a company, which involves understanding the narrative behind a business and its alignment with personal values. The author discusses the importance of crafting a personal story for each investment, which includes evaluating the company's mission, management, and competitive advantages. This narrative approach encourages investors to look beyond financial metrics and consider the ethical implications of their investments. The author emphasizes the value of thorough research in understanding a company's history, values, and potential for growth. Additionally, the chapter highlights the collaborative aspect of investing, as the author engages with their father to refine their investment strategies and perspectives. This mentorship dynamic fosters a deeper understanding of the investing process and reinforces the importance of aligning investments with personal values. The author concludes with a sense of empowerment, feeling more confident in their ability to navigate the investing landscape with purpose and intention. In this chapter, we delve into the foundational principles of value investing, focusing on the efficient market hypothesis, EMH, and its implications for investors. The chapter begins with an introduction to the concept of value investing, emphasizing the need to understand the market context in which companies operate. The efficient market hypothesis posits that if all market participants are rational, stock prices should reflect all available information. This leads to the conclusion that consistently beating the market is nearly impossible. However, the chapter presents counterexamples, particularly Warren Buffett's remarkable investment success, which challenges the validity of EMH. The narrative introduces the idea of lucky monkeys, suggesting that while some investors may appear to succeed by chance, Buffett's consistent performance indicates a deeper understanding of market dynamics. The chapter encourages readers to recognize that market inefficiencies exist, and that understanding these can lead to successful investing strategies. Overall, it sets the stage for exploring the principles that underpin value investing and the mindset required to navigate the complexities of the stock market. The efficient market hypothesis, EMH, is a cornerstone of modern financial theory, asserting that stock prices are always fair and reflect all available information. This hypothesis relies on the assumption that investors act rationally, making decisions based on the intrinsic value of stocks. However, the chapter highlights the challenges of consistently outperforming the market, as EMH suggests that any new information is quickly incorporated into stock prices, leaving little room for profit. Warren Buffett's extraordinary investment track record serves as a compelling counterexample to EMH. His ability to achieve returns far exceeding the market average raises questions about the validity of the hypothesis. The chapter also emphasizes the emotional aspects of investing, illustrating how fear and greed can lead to irrational market behavior. This understanding of market psychology is crucial for value investors, as it allows them to identify opportunities when others are driven by emotion rather than rational analysis. Ultimately, the chapter sets the stage for a deeper exploration of how to navigate the complexities of investing in an environment influenced by both rationality and emotion. Warren Buffett's perspective on market inefficiencies provides valuable insights for aspiring investors. He critiques the efficient market hypothesis, arguing that it fails to account for the emotional and irrational behaviors exhibited by market participants. The chapter introduces the concept of lucky monkeys, suggesting that while some investors may achieve success by chance, Buffett's consistent performance is rooted in a deep understanding of business fundamentals. To identify true investment opportunities, Buffett emphasizes the importance of thorough research and analysis. He advocates for a patient approach to investing, encouraging investors to wait for the right moment to capitalize on market inefficiencies. This patience is crucial, as it allows investors to buy undervalued stocks when others are selling out of fear. The chapter underscores the need for a disciplined investment strategy that focuses on understanding the underlying value of businesses rather than being swayed by market trends. By adopting Buffett's principles, investors can navigate the complexities of the market and make informed decisions that lead to long-term success. In the context of value investing, the chapter introduces the concept of events, which are unexpected occurrences that create temporary uncertainty about a company's cash flow. These events can range from industry-specific issues to broader market crises. The distinction between temporary problems and terminal issues is crucial for investors, as it helps them determine whether a stock is worth holding or selling. The case study of Gildan, a leading t-shirt manufacturer, illustrates how a temporary cotton shortage led to significant market reactions. While the CEO indicated that the issue was short-lived, many fund managers sold off their shares due to fear, creating an opportunity for value investors. The chapter emphasizes the importance of conducting thorough research to understand the nature of events and their potential impact on stock prices. By identifying and analyzing events, investors can position themselves to take advantage of market inefficiencies. The chapter encourages readers to remain vigilant and informed, as this knowledge will empower them to make strategic investment decisions during times of uncertainty. Ultimately, understanding the role of events is a key component of successful value investing. The concept of the circle of competence is central to effective value investing. It refers to the areas in which an investor has a deep understanding and familiarity, allowing them to make informed decisions. The chapter emphasizes the importance of focusing on industries and companies that align with one's personal experiences and interests. To help identify potential investment opportunities, the chapter introduces a 3 circles exercise that encourages investors to consider their passions, spending habits, and income sources. By mapping these areas, investors can pinpoint industries where they already possess knowledge and insights. This targeted approach not only enhances confidence, but also increases the likelihood of making sound investment choices. Researching companies within one circle of competence is essential for successful investing. The chapter highlights the value of leveraging personal experiences and insights to evaluate potential investments. Additionally, it encourages investors to continuously expand their circle by exploring new industries and acquiring knowledge. By doing so, investors can enhance their decision-making capabilities and ultimately achieve greater success in their investment endeavors. In this chapter, we delve into the principles of investing as articulated by Charlie Munger, particularly focusing on the concept of a moat. The chapter begins with a personal narrative that highlights the author's journey towards financial freedom and the unexpected sense of liberation that comes with it. This sets the stage for understanding the importance of investing principles in achieving financial goals. The chapter emphasizes the significance of identifying a company's competitive advantages, which Munger refers to as a moat. This metaphorical moat protects a business from competitors, ensuring its long-term profitability. The author shares insights from discussions with their father, who elaborates on the intrinsic and durable nature of a moat, distinguishing it from mere competitive advantages. As the chapter progresses, it transitions into the realm of financial analysis, where the author expresses a mix of excitement and apprehension about understanding financial statements. This journey is not just about numbers. It's about making informed investment decisions based on a company's ability to maintain its competitive edge. The chapter concludes with a promise of further exploration into the financial metrics that underpin these principles, setting the stage for a deeper dive into the world of investing. This section of the chapter provides a comprehensive understanding of what constitutes a moat in the context of investing. The author explains that a moat is not just any competitive advantage. It must be intrinsic to the business and durable over time. This means that the advantage cannot be easily replicated or overcome by competitors. The chapter outlines various types of moats, including brand moats, which are exemplified by companies like Coca-Cola, and switching moats as seen with Apple. The author emphasizes that a strong moat is crucial for a company's long-term success, as it protects against competitive threats and ensures sustained profitability. However, assessing the strength of a moat can be challenging. The author reflects on the complexities involved in determining whether a company's competitive advantage is truly durable. This discussion encourages readers to think critically about the businesses they are interested in and to consider the long-term implications of their competitive positioning. Overall, this section serves as a foundational understanding of moats, setting the stage for further exploration into financial metrics and management evaluation in the subsequent parts of the chapter. In this part of the chapter, the author introduces the concept of the Big Four numbers, which are essential for evaluating a company's financial health. These numbers are derived from financial statements and provide critical insights into a company's performance. Net income is highlighted as a key indicator of profitability, representing the profit remaining after all costs have been deducted. Book value offers a snapshot of the company's worth if it were to liquidate its assets, while sales reflect the revenue generated from operations. Operating cash is particularly important as it reveals the actual cash flow, which is crucial for understanding a company's liquidity and operational efficiency. The author emphasizes that these numbers should not only be viewed in isolation, but should be analyzed over time to identify trends and patterns. Consistency in these figures can indicate a company's ability to maintain its competitive advantage and moat. This section serves as a bridge between the conceptual understanding of moats and the practical application of financial analysis, preparing readers for a deeper dive into evaluating management and making informed investment decisions. This section focuses on the critical role that management plays in the success of a company and, consequently, in investment decisions. The author discusses the importance of evaluating the management team, particularly the CEO, as they are responsible for steering the company towards its goals. Key traits of effective management include integrity, transparency, and a proven track record of success. The author suggests researching the backgrounds and management styles of CEOs to gain insights into their decision-making processes. Understanding whether a CEO is a visionary leader or a more conservative manager can influence investment choices significantly. The board of directors also plays a crucial role in overseeing management and ensuring that the company is being run in the best interests of shareholders. The author emphasizes the need to assess the integrity of management, as trustworthiness is paramount in the investment world. Overall, this section highlights that management decisions can have a profound impact on a company's performance and its ability to maintain its moat. Investors are encouraged to conduct thorough research into management teams to make informed investment choices. In the final section of the chapter, the author discusses the importance of creating a checklist for investing, drawing parallels to its use in other fields such as medicine and aviation. Checklists help investors remain organized and ensure that they consider all relevant factors when evaluating potential investments. The author outlines Charlie's 4 principles of investing, which serve as the foundation for the checklist. These principles guide investors in assessing a company's understanding, moat, management, and reasonable pricing. By systematically evaluating these components, investors can make more informed decisions and reduce the emotional biases that often cloud judgment. The author emphasizes that a well-structured checklist should be concise yet comprehensive, allowing for efficient evaluation without overwhelming the investor. Additionally, the checklist should be continuously improved based on experiences and outcomes, ensuring that it remains relevant and effective over time. This section concludes the chapter by reinforcing the idea that a disciplined approach to investing, supported by a solid checklist, can lead to better investment outcomes and a deeper understanding of the principles that underpin successful investing. This introduction sets the stage for Chapter 6, titled Circling Competence. The chapter delves into the author's personal experiences and reflections on investing over a 6-month period. It emphasizes the significance of practice in investing, highlighting how the author has laid out their investing office in preparation for an important call. The mention of brokerage accounts and fantasy investing introduces key concepts that will be explored further in the chapter. Additionally, the influence of family traditions on financial decisions is acknowledged, suggesting that our backgrounds play a crucial role in shaping our investment strategies. The author's excitement and anticipation for the upcoming investing call indicate a proactive approach to learning and growth in the investment space. Overall, this introduction encapsulates the essence of the chapter, inviting readers to explore the author's journey and insights into the world of investing. In this section, we explore the author's journey through 6 months of dedicated investing practice. The author reflects on the importance of learning from both successes and failures, which is a crucial aspect of any growth process. A structured approach to investing is emphasized, as it helps in developing a personal investment strategy that aligns with individual goals and risk tolerance. The role of mentorship is also highlighted, showcasing how guidance from experienced investors can significantly enhance one's understanding of the market. As the author gains more experience, confidence in their investment decisions grows, illustrating the positive feedback loop that occurs when one actively engages in the investing process. This section serves as a reminder that investing is not just about making money, It's about continuous learning and personal development. This part of the chapter focuses on the basics of brokerage accounts, which are essential for anyone looking to invest in the stock market. The author discusses the various types of brokerage accounts available, emphasizing the importance of selecting the right broker that aligns with one's investment goals. Fees and commissions are critical factors to consider, as they can significantly impact overall returns. The tools and resources provided by brokers are also highlighted, showcasing how technology has transformed the investing landscape. The author explains the process of opening and managing a brokerage account, making it accessible for beginners. This section serves as a practical guide for readers, equipping them with the knowledge needed to navigate the world of brokerage accounts effectively. In this section, the author introduces the concept of fantasy investing, which allows individuals to engage in simulated investing experiences without the financial risks associated with real investments. This approach provides numerous benefits, including the opportunity to learn and practice investment strategies in a risk-free environment. The author emphasizes how fantasy investing can help develop analytical skills, as participants must analyze market trends and news to make informed decisions. This engagement with the market fosters a deeper understanding of how various factors influence stock prices. The transition from fantasy investing to real investing is also discussed, highlighting the importance of applying the skills learned in simulations to actual investment scenarios. This section encourages readers to consider fantasy investing as a valuable tool in their investment journey. The final section of the chapter delves into the influence of family traditions on financial habits and attitudes towards money. The author reflects on how lessons learned from parents and family members shape one's approach to money management and investing. Cultural perspectives on investing are also explored, illustrating how different backgrounds can impact financial decisions. The role of family discussions in shaping views about money is emphasized, highlighting the importance of open conversations about finances. The author notes that passing down financial wisdom through generations can empower individuals to make informed decisions. This section serves as a reminder that our financial behaviors are often rooted in our upbringing, and fostering open dialogues about money can lead to healthier financial practices in the future. In this chapter, we delve into Charlie Munger's fourth principle of investing, which emphasizes the importance of pricing when making investment decisions. Munger advises investors to avoid paying an infinite price for a company, and instead focus on finding a price that makes sense, ideally one that is lower than the reasonable price. This principle is crucial for building a margin of safety, which protects investors from potential losses. The chapter introduces several pricing methods, including the 10-cap pricing method, which is based on owner earnings, and the payback time pricing method, which considers free cash flow. Understanding these methods is essential for investors who want to make informed decisions and avoid overpaying for stocks. Owner earnings is a key concept discussed in this chapter, as it represents the cash that can be taken out of a business without affecting its operations. This metric is vital for determining a company's value and ensuring that investors are making sound financial decisions. Additionally, the chapter highlights the significance of the margin of safety, which serves as a buffer against errors in judgment or unforeseen market fluctuations. By applying these principles and methods, investors can enhance their ability to identify undervalued companies and make more strategic investment choices. The chapter elaborates on the concept of pricing using whole company numbers, which is a fundamental approach in value investing. This method encourages investors to think about the entire company, rather than just its stock price. The 10-cap pricing method is introduced as a straightforward way to determine a reasonable price for a business based on its owner earnings. Owner earnings is defined as the cash that can be extracted from a business without hindering its operations, making it a crucial metric for investors. By focusing on owner earnings, investors can gain a clearer understanding of a company's financial health and its ability to generate cash flow. The chapter also emphasizes the importance of understanding cash flow in the context of pricing. Real-world examples illustrate how these concepts can be applied in practice, reinforcing the connection between pricing strategies and the overall investment philosophy. This approach not only aids in identifying undervalued companies, but also aligns with the principles of conservative investing advocated by Munger and Buffett. The payback time pricing method is a key focus of this chapter, defined as the number of years it takes to recover the entire purchase price of an investment. This method is particularly appealing to investors seeking quick returns, as it reduces the risk of losing money over time. The calculation of payback time involves estimating future cash flows and applying a growth rate, known as the windage growth rate, to project how quickly the investment will pay itself back. An example using a rental house illustrates how this method works in practice, showcasing the importance of understanding the underlying business dynamics. The chapter also compares the payback time method with traditional public company pricing, highlighting the differences in liquidity and valuation approaches. By focusing on businesses that are easy to understand and have a strong competitive advantage, investors can make informed decisions that align with their investment goals. The concept of margin of safety is crucial in the context of valuation and investment decisions. It serves as a protective buffer that allows investors to mitigate risks associated with potential miscalculations or unforeseen market events. By ensuring that the price paid for an investment is significantly lower than its intrinsic value, investors can safeguard their capital and enhance their chances of achieving positive returns. Calculating the margin of safety involves assessing the intrinsic value of a company and comparing it to the market price. The chapter provides examples of how this principle can be applied in practice, illustrating its significance in real-world investment scenarios. Furthermore, the margin of safety is closely connected to an investor's overall strategy, as it encourages a disciplined approach to buying stocks. By prioritizing investments with a strong margin of safety, investors can effectively manage risk and increase their likelihood of long-term success in the market. In conclusion, this chapter provides a comprehensive overview of Charlie Munger's fourth principle of investing, emphasizing the critical role that pricing plays in making sound investment decisions. By understanding and applying the various pricing methods discussed, including the 10-cap and payback time, investors can enhance their ability to identify undervalued companies and make informed choices. The chapter highlights the importance of owner earnings as a key metric for valuation, as well as the significance of the margin of safety in protecting against potential losses. These principles not only align with the conservative investment philosophy advocated by Munger and Buffett, but also serve as essential tools for effective risk management. As readers reflect on the key takeaways from this chapter, they are encouraged to apply these principles in their own investing practices. By doing so, they can build a solid foundation for successful investing and navigate the complexities of the financial markets with confidence. In this chapter, we delve into Charlie's fourth principle, which emphasizes the importance of value in investing. The margin of safety valuation method is introduced as a crucial tool for investors. This method helps in determining a price that provides a cushion against errors in analysis. The chapter highlights the significance of earnings per share, EPS, as a fundamental metric for assessing a company's profitability. Understanding the windage growth rate is essential, as it allows investors to estimate future growth based on historical data and market conditions. The windage price-to-earnings (PE) ratio is also discussed, providing insight into how a company's earnings relate to its market price. Lastly, the minimum acceptable rate of return (MAR) is introduced, which serves as a benchmark for evaluating investment opportunities. This chapter sets the stage for a deeper understanding of how to value a business effectively. The concept of margin of safety is pivotal in investing, as it refers to the difference between a company's intrinsic value and its market price. This chapter emphasizes the importance of purchasing stocks at prices below their intrinsic value to safeguard against potential errors in analysis. By doing so, investors create a buffer that can protect them from unforeseen market fluctuations or miscalculations. The chapter also discusses the real-world implications of information asymmetry, where investors may not have access to all relevant information about a company. This lack of transparency can lead to significant risks, making the margin of safety even more critical. Strategies for identifying a margin of safety are explored, encouraging investors to conduct thorough research and analysis to make informed decisions. Overall, This section reinforces the idea that a disciplined approach to investing can lead to more successful outcomes. In this section, we explore various valuation methods that investors can utilize to assess a company's worth. The chapter begins by discussing owner earnings and free cash flow methods, which provide insights into a company's financial health. However, the focus shifts to an earnings-based valuation approach, which is particularly relevant for public companies. The importance of using consistent metrics throughout the valuation process is emphasized, as inconsistencies can lead to confusion and misinterpretation of data. The chapter also highlights the differences between valuing public and private companies, noting that public companies often have more accessible financial data. Additionally, the introduction of discounted cash flow analysis is presented as a sophisticated method for determining a company's value based on future cash flows. This section serves as a foundation for understanding the various approaches to valuation and their respective applications. Calculating the margin of safety price involves a systematic approach that requires several key steps. The chapter outlines these steps, starting with the calculation of earnings per share, EPS, and the windage growth rate, which are essential for estimating future earnings. The windage PE ratio plays a crucial role in determining the expected market price based on earnings. The process involves working backward from projected future earnings to arrive at a present value, which is then adjusted to account for the margin of safety. Practical examples such as the lemonade stand are used to illustrate these calculations, making the concepts more relatable and easier to understand. By breaking down the process into manageable steps, the chapter empowers readers to apply these methods in their own investment analyses, reinforcing the importance of a disciplined approach to valuation. The final section of the chapter focuses on the real-world application of the margin of safety method and the various valuation techniques discussed earlier. It emphasizes the importance of comparing different pricing methods to arrive at a well-rounded understanding of a company's value. The chapter encourages readers to practice these valuation techniques to build confidence and proficiency in their investing skills. Additionally, it addresses the emotional aspects of investing, acknowledging that fear and uncertainty can often accompany financial decisions. By recognizing these emotions, investors can better navigate the complexities of the market. The chapter concludes with a message of encouragement, urging readers to take calculated risks and apply their newfound knowledge in real investment scenarios. This final note reinforces the idea that investing is a journey of continuous learning and growth. In this chapter, the author delves into the concept of confirmation bias, which is the tendency to favor information that confirms one's pre-existing beliefs. This bias can lead investors to overlook critical flaws in companies they are emotionally attached to. The author emphasizes the importance of maintaining a skeptical mindset when researching potential investments. To combat this bias, the author discusses the creation of a checklist of expensive errors that can help identify common pitfalls in investment decisions. This checklist serves as a tool for self-assessment and reflection, ensuring that investors do not repeat past mistakes. Additionally, the chapter highlights the significance of engaging with peers and discussing investment ideas with trusted friends or mentors. This collaborative approach can provide valuable insights and help investors see their ideas from different perspectives. The author shares personal anecdotes about conversations with their father, who emphasizes the need for rigorous examination of investment arguments. By discussing and debating investment ideas, investors can challenge their assumptions and make more informed decisions. Overall, the chapter underscores the importance of self-awareness and critical thinking in the investment process. The author introduces a structured approach to investing through the use of a checklist of expensive errors. This checklist is designed to help investors avoid common pitfalls that can lead to significant financial losses. By identifying key components of the checklist, the author emphasizes the importance of being aware of one's own biases and mistakes. The checklist serves as a reminder to assess each investment opportunity critically and to learn from past errors. The author also discusses the role of emotional detachment in decision-making. By recognizing the emotional attachment that can develop towards certain companies, investors can better navigate their investment choices. The checklist encourages a rational evaluation of potential investments, allowing investors to make decisions based on facts rather than feelings. This structured approach not only helps in avoiding costly mistakes, but also fosters a mindset of continuous learning and improvement in the investment journey. In this section, the author emphasizes the importance of combating confirmation bias through peer discussions. Engaging with trusted friends or mentors allows investors to challenge their assumptions and gain new perspectives on their investment ideas. The author introduces the concept of inverting the story of a company, which involves examining the reasons against investing in a particular business. This technique encourages investors to critically assess their beliefs and identify potential weaknesses in their arguments. The author also highlights the significance of emotional awareness in investing. By recognizing the emotional factors that influence decision-making, investors can develop strategies to maintain objectivity. Techniques for self-examination, such as journaling or discussing investment ideas with peers, can help investors stay grounded and make more rational choices. Overall, this section underscores the need for a proactive approach to overcoming biases and ensuring sound investment decisions. The author outlines the steps involved in creating an inverted story for a company, emphasizing the importance of rigorous examination. This process requires investors to take their reasons for wanting to invest and flip them into arguments against the investment. By doing so, investors can identify potential flaws and weaknesses in their reasoning. The author shares personal experiences of the emotional challenges faced when inverting a beloved company, highlighting the difficulty of confronting biases and attachments. Writing down arguments is presented as a valuable tool in the inversion process. By articulating thoughts on paper, investors can clarify their reasoning and ensure they have considered all aspects of the investment. This practice not only aids in the decision-making process, but also fosters a deeper understanding of the company and its potential risks. The author encourages readers to embrace the inversion process as a means of enhancing their investment analysis and making more informed decisions. In this final section, the author introduces the concept of practice shares, which allows investors to gain experience without the pressure of making significant financial commitments. This approach serves as an emotional test drive, helping investors navigate their feelings about buying shares. By practicing with a small amount of money, investors can build confidence and become more comfortable with the process of investing. The author discusses the importance of experience in investing, noting that real ownership of shares can lead to a deeper understanding of the company and its dynamics. This experience helps investors balance their emotional responses with rational analysis, allowing them to make more informed decisions in the future. The chapter concludes by encouraging readers to embrace the learning process and view each investment as an opportunity for growth, both financially and personally. In this chapter, we delve into the concept of compiling an anti-fragile portfolio, which is a strategy that not only withstands market volatility, but actually benefits from it. The chapter begins with a conversation between the narrator and her father, highlighting the importance of patience in investing. The father emphasizes that buying stocks out of pressure or fear is not true investing. Rather, it is speculation. This sets the stage for understanding how to build a portfolio that thrives in chaotic market conditions. The narrator expresses her eagerness to transition from practice shares to real investments, which reflects a common sentiment among new investors who feel the pressure to act. The chapter also introduces the idea of a wishlist buying plan, which is a crucial tool for identifying potential investments and determining when to buy them. This plan is essential for maintaining focus and discipline in the face of market fluctuations. Overall, the chapter emphasizes the importance of emotional management and strategic planning in building a successful investment portfolio. The concept of an anti-fragile portfolio is rooted in the idea that certain investments can actually benefit from market chaos. This chapter discusses how traditional mutual funds and index funds are often fragile, meaning they can suffer significant losses during market downturns. In contrast, an anti-fragile portfolio is built around companies with durable moats, competitive advantages that allow them to thrive even in adverse conditions. These companies can raise prices during inflation and maintain customer loyalty during deflation, making them resilient in the face of economic challenges. The chapter highlights historical market events that have caused widespread damage to fragile portfolios, emphasizing the need for a strategic approach to investing. By focusing on companies that are not only stable, but also capable of emerging stronger from crises, investors can create a portfolio that is not just resilient but anti-fragile. This understanding is crucial for anyone looking to navigate the complexities of the stock market successfully. The wishlist buying plan is a vital tool for investors looking to make informed decisions. This plan allows investors to identify companies they are interested in and set specific buy prices for each. By prioritizing their favorite companies, investors can focus their efforts on the stocks they truly believe in. The chapter emphasizes the emotional aspect of investing, particularly the fear of missing out and the pressure to act quickly. By having a clear plan in place, investors can manage these emotions and avoid making impulsive decisions. The use of alerts for price changes is also highlighted, as it helps investors stay informed without constantly monitoring the market. This proactive approach to investing not only enhances decision-making, but also instills confidence in the investor's strategy. Overall, the wishlist buying plan serves as a roadmap for navigating the complexities of the stock market while maintaining emotional stability. Buying in tranches is a strategic approach that allows investors to manage their capital more effectively, while also controlling their emotions. The concept of tranches refers to dividing the total investment into smaller portions, which can be purchased at different price points. This method is particularly useful during market fluctuations, as it enables investors to take advantage of lower prices without committing all their capital at once. The chapter discusses how this strategy helps mitigate the emotional turmoil that often accompanies investing, such as fear and greed. By allocating funds in portions, investors can remain patient and wait for the right opportunities to buy. This approach not only enhances the potential for better returns, but also fosters a disciplined mindset. The importance of patience is reiterated, as successful investing often requires waiting for the right moment to act. Overall, buying in tranches is a valuable strategy for building an anti-fragile portfolio. Managing emotions during market events is crucial for successful investing. The chapter highlights the common emotional triggers that investors face, particularly fear and greed. These emotions can lead to impulsive decisions that undermine long-term investment strategies. By recognizing these triggers, investors can better prepare themselves to respond rationally rather than reactively. The importance of having a solid plan in place is emphasized, as it provides a framework for decision-making during turbulent times. Staying focused on long-term goals helps investors maintain perspective and avoid getting caught up in short-term market fluctuations. Additionally, learning from past experiences can provide valuable insights into how to navigate future challenges. The chapter encourages investors to embrace the journey of investing as a lifelong practice, where emotional resilience and strategic planning go hand in hand. Ultimately, managing emotions is a key component of building an anti-fragile portfolio that can withstand the test of time. In this chapter, the author shares their excitement about transitioning from practice investing to real investing. The narrative begins with a sense of urgency and eagerness to apply the knowledge gained. The author reflects on the importance of patience, emphasizing that buying should come before selling. The chapter highlights the role of dividends and buybacks in investment strategy, which are crucial for understanding when to sell. The decision to buy Whole Foods is a pivotal moment, showcasing the author's confidence and the support received from their father, who acts as a mentor. This emotional journey illustrates the complexities of investing, where excitement and anxiety coexist, as the author navigates the world of real investments. The author reflects on their father's advice, which emphasized the importance of waiting before making any purchases. Despite this, the author felt a strong instinct to invest, demonstrating the internal conflict between patience and eagerness. The communication with the father is crucial, as it reinforces the bond formed through their shared investment journey. The rationale behind choosing Whole Foods is articulated, showcasing the author's understanding of the company's strengths, such as its brand loyalty and financial health. This moment signifies the author's emotional readiness to take the leap into real investing, and the ease of executing the purchase highlights the confidence gained through practice. The narrative captures the blend of excitement and apprehension that accompanies significant financial decisions. In this section, the father shares his perspective on selling investments, emphasizing that the right time to sell is never unless the company's story changes. This insight highlights the importance of understanding the underlying narrative of a company, which is crucial for long-term investment success. The concept of compounding returns is introduced, illustrating how holding on to investments can lead to greater financial rewards over time. The discussion also touches on the impact of changing market conditions and the necessity of evaluating management integrity. The balance between price and value is a recurring theme, reminding investors to focus on the fundamental health of a company rather than short-term fluctuations. This understanding is vital for making informed decisions about when to sell. This section delves into the role of dividends and buybacks in investment strategy. Dividends are defined as cash payments made to shareholders, which can significantly impact an investor's basis in a stock. The concept of basis reduction is introduced, explaining how dividends can lower the amount of capital invested in a stock, thereby reducing risk. The importance of free cash flow is emphasized, as it allows companies to return value to shareholders through dividends or buybacks. Buybacks are discussed as a strategy for increasing shareholder value by reducing the number of outstanding shares. The psychological aspect of dividends is also explored, highlighting how investors can become attached to dividend payments, leading to unrealistic expectations. The potential pitfalls of relying too heavily on dividends are cautioned against, encouraging a focus on overall company health. The final section of the chapter focuses on knowing when to sell an investment. The concept of story inversion is introduced, which involves identifying potential risks that could negatively impact a company's performance. This proactive approach encourages investors to stay vigilant and continuously monitor their investments. Ongoing research is emphasized as a critical component of successful investing, as it allows investors to stay informed about company performance and external market factors that could influence their decisions. The balance between vigilance and practicality is highlighted, reminding investors that while it's essential to stay informed, they should not become overwhelmed by the constant flow of information. This section reinforces the idea that successful investing requires a combination of knowledge, intuition, and a willingness to adapt to changing circumstances. In this chapter, the author reflects on a transformative year of investing practice, emphasizing the importance of intention and the act of asking for help. The narrative begins with a moment of relaxation before a call with the author's dad, highlighting the busy holiday season and the nearing end of the year. The author recalls feelings of insecurity and fear at the beginning of the year, particularly regarding health, job security, and financial future. However, a pivotal moment occurs when the author decides to put intentions out into the universe, leading to unexpected support and options. This chapter illustrates the journey from fear to confidence, showcasing how the author learned to confront and respect their fears, ultimately leading to a deeper understanding of investing and a closer relationship with their father. The concept of anti-fragility emerges as a key theme, suggesting that through challenges, one can grow stronger and more resilient. This section of the chapter delves into the significant role that family, particularly the author's father, plays in the investing journey. The author reflects on how their relationship has strengthened through shared experiences in investing practice. The pacing of learning is highlighted as a crucial aspect, with the father respecting the author's individual journey and allowing for personal growth. The narrative emphasizes the importance of adapting traditional methods to fit personal learning styles, showcasing a mutual respect that has developed between the author and their dad. The joy of teaching and learning together is palpable, as both parties benefit from the exchange of knowledge and ideas. This collaborative approach not only enhances the learning experience but also deepens their familial bond, illustrating how investing can serve as a vehicle for connection and understanding. In this part of the chapter, the author discusses the transition from unconscious incompetence to conscious competence in investing. Initially, the author felt overwhelmed and fearful, but as knowledge was gained, that fear began to dissipate. The narrative illustrates how understanding market dynamics and company evaluations became empowering, allowing the author to take a proactive approach to investing. Mistakes are acknowledged as a natural part of the learning process, reinforcing the idea that growth often comes from facing challenges head-on. The author emphasizes the importance of building a checklist for ongoing practice, which serves as a stabilizing force during moments of uncertainty. This checklist not only helps in maintaining focus, but also ensures that critical aspects of investing are not overlooked. The journey of overcoming fear through knowledge and practice is a central theme, showcasing the transformative power of education in the realm of investing. The chapter further explores the concept of freedom, particularly how it is redefined through gaining control over finances. The author reflects on the emotional journey of letting go of fear, which has been a significant barrier to personal growth. Investing is portrayed not just as a financial endeavor, but as a means to enhance overall life satisfaction. The narrative highlights the joy of embracing new opportunities and experiences that arise from this newfound freedom. Ongoing learning and adaptation are emphasized as essential components of this journey, reinforcing the idea that personal growth is a continuous process. Celebrating milestones, such as the completion of a year of investing practice, serves as a reminder of how far the author has come. This section encapsulates the transformative power of investing, illustrating how it can lead to a more fulfilling and liberated life. In this part of the chapter, the author reflects on the teachings of Warren Buffett and Charlie Munger, two of the most influential figures in the world of investing. Buffett's desire to be remembered as a good teacher resonates deeply with the author, who recognizes the importance of imparting knowledge about investing to future generations. This focus on education highlights the idea that true wealth is not just about financial assets, but also about the wisdom and values that guide investment decisions. The author emphasizes the significance of values in investing, suggesting that successful investing is intertwined with ethical considerations and personal beliefs. This perspective is crucial for creating generational wealth, as it ensures that the knowledge passed down is not only about making money, but also about making responsible choices. Personal anecdotes about teaching investing to the author's daughter, Danielle, illustrate the challenges and rewards of fostering an interest in financial literacy. The author shares heartwarming memories of bonding with Danielle over discussions about companies and investments, showcasing the deep connection between family and financial education. The impact of Buffett and Munger on modern investing is profound, as their strategies challenge conventional wisdom and encourage a long-term perspective. The author acknowledges the revolutionary nature of their teachings, which have the potential to empower individuals and families to achieve financial independence. This section serves as a reminder that investing is not just a personal endeavor. It is a legacy that can shape the future for generations to come. The author delves into the concept of generational wealth, using the Patel family's success story as a prime example. The Patels, who immigrated to the United States with limited resources, leveraged their knowledge of the hospitality industry to build a thriving business empire. This narrative illustrates that wealth is not solely defined by monetary assets. Rather, the knowledge and skills passed down through generations can be equally valuable. The author emphasizes the importance of teaching the next generation about investing, highlighting the emotional connection that comes with financial education. By instilling a sense of responsibility and understanding in their children, parents can empower them to make informed financial decisions that will benefit their families for years to come. The role of family in wealth creation is a recurring theme in this section. The author reflects on their own experiences with Danielle, expressing a desire to rebuild trust and connection through shared learning about investing. This emotional aspect of financial education adds depth to the narrative, showcasing how investing can strengthen family bonds. Building a legacy through investing is a powerful concept that resonates with the author. The idea that knowledge about creating wealth can be passed down is not only inspiring but also transformative. It encourages individuals to think beyond their own financial success and consider the impact they can have on future generations. This section serves as a call to action for readers to embrace the responsibility of teaching and sharing their investment knowledge with those they love. In the conclusion of the chapter, the author reflects on the emotional journey of investing, acknowledging that it is filled with both triumphs and challenges. The act of investing is not just about financial gains. It is a deeply personal experience that evokes a range of emotions. Celebrating successes, such as the impressive return on investment from Whole Foods, is essential, but equally important is the ability to learn from losses and setbacks. The author emphasizes the importance of continuous learning in the world of investing. Each experience, whether positive or negative, contributes to a deeper understanding of the market and investment strategies. This commitment to growth is a hallmark of successful investors, who recognize that the journey is ongoing and ever-evolving. Building connections through shared experiences is another key theme in this conclusion. The author highlights the relationships formed through discussions about investing, whether with family members or fellow investors. These connections enrich the investment journey, providing support and encouragement along the way. Looking forward to future investments, the author expresses excitement and optimism. The joy of practicing investing is evident, as the author is eager to continue exploring new opportunities and expanding their knowledge. This forward-looking perspective encapsulates the essence of investing as a lifelong journey, filled with discovery, growth, and the potential for meaningful impact.